Okay, dear students, let's quickly start the second live revision class of FM. So, in investment appraisal, we started the area of relevant, irrelevant. Then we did discuss the Fisher effect, how to convert real cost of capital to nominal, nominal to real. Now, let us quickly discuss conversion of the cash flows. How do we convert real cash flows to nominal? Real means without inflation. Nominal means with inflation. There are a few other terms which are possible to be used for, they can use for the nominal cash flows, like money cash flow, monetary cash flows. So how do we convert real cash flows to nominal cash flows? Simply, how do we incorporate inflation to our real cash flows? Number one, if examiner is using the word current price, another term is year zero price. Just a minute, student. Okay, let's say examiner is using the word either current price, year zero price, one more possibility. Let's say present day price. A real term price. So if your examiner says given prices are current prices or year zero prices or present day prices or real term prices, sometimes examiner gives you another information like given data is without considering the inflation. Obviously, when examiner is writing given data is without considering the inflation, it means given cash flows are real. So whenever current price, year zero, present day, real term price, any one of the term is used out of these four, inflation will be incorporated from first year. Inflation comes from the first year. If your examiner says year one price, actually year one price means inflation of year one is already included. Then what you are supposed to do, you are supposed to incorporate the inflation from second year. Incorporate inflation from second year. For example, examiner says the given prices are 2024 prices. When you say 2024 prices, it means inflation till 2024 is included. Now you are actually required to include the inflation from 2025 onwards. Okay. Now let's see a very simple question. Time T1, T2, T3, T4. Current price 100. Let's say 120. We can make it 100 so that we can apply the shortcut as well. Inflation per annum. It is 12%, 12%, 12%, 12%, and 12%. You are required to calculate nominal price. Nominal price means with inflation. Obviously, if you just multiply this with 1.12, I'll get 112. Then here it will be 1.12 power 2. So 100 multiplied by 1.12 power 2, I'm getting 125.44. Now this 125.44 can be calculated directly as well. If you directly multiply 112 with 1.12, you will get the same result. So students, you should be really good in this. If you are working on 100, For the second year, then there will be power 2. If you're directly working on 112, then 112 multiplied by 1.12 will give you 125.44. Now here, power 3, or another way to calculate the result is just multiply 125.44 with 1.12. So you will get the same result. If 100 multiplied by 1.12 power 3, I'm getting 140.49, let's say 28. Here it will be power 4. So 157.35. Okay, now second question. T1, T2, T3, T4. Current average price is 100, 122, 115, 126. Inflation per annum is 10%. Nominal price. Student, please quickly calculate the nominal price. Everyone. Okay, let's see. Results are here. 100 multiplied by 1.1, we'll get 110. Now, shortcut is not possible. You cannot directly multiply 110 with 1.1, incorrect. Because every year value is not same. Now you have to work like this. Take power 2, then take power 3, take power 4. There is no other way to calculate the nominal price. There is no other way to calculate the nominal price. Why? Shortcut is not possible because the value is every year different. So 1.12 power 2, I'm getting 147.62. Look at this, both the questions are different. Here, inflation is same, values are also same. So shortcut is applicable. Here, inflation is same, but the shortcut is values are not every year same. So shortcut is not possible. There's only one way to calculate the nominal price. That is, you have to take the powers. 115 into 1.1. Power 3, I get 153.065. Question 3. T1, T2, T3, T4. Average current price. 140, 145, 155, and let's say 163. Inflation per annum. 18%, 15, 12, and 13. Nominal price. Please, students, everyone, attempt this. Please, students, I want everyone to solve this rather than only one student. Please, I want answer from everyone. Attempt this, please. Let's see. Okay, student, now be careful. Inflation is changing every year. Inflation is changing every year. So, number one, there is no shortcut to solve this now. Just multiply this with 1.18, and plus, it's not only the inflation is changing every year, plus the values are different also every year. So both the things are different. Inflation is changing every year and values are changing every year also. Number one is 165.065. 2. The second, 1.18 into 1.15. You cannot take power because inflation is different every year. So 145 into 1.18 multiplied by 1.15. 196.765. Here it will be 1.18, 1.15, 1.12. So 155 into 1.18 into 1.15 into 1.12. I'm getting 235.575. Now 1.18, 1.15, 1.12, 1.13. 163 multiplied by 1.18 into 1.15 into 1.12 into 1.13. So with a little bit rounding off, you can take 280. So there are three possibilities regarding this, how to convert real cash flows to nominal. We have discussed all three of them. Why here we cannot take power in question number 3? Because inflation is different in every year. In first two questions, in power was possible because inflation was same. Like in maths, we do study when this x multiplied by x, when bases are common, then power can be added. It's a very simple maths. But obviously, when bases are different, then you cannot add the power. X multiplied by y will be x and y. It cannot be power. So in the last question, basically what is happening? Why we are not taking power? Because of inflation is changing every year. Okay, now let's go ahead. Now another point which is very important. When in the same question there are more than one inflation rate, then logically it becomes compulsory. Yes, law of indices. So simply, if in the question there are more than one inflation rate, then it is necessary, it is compulsory to calculate NPV in nominal terms. But if there is a single inflation rate, actually then it makes no difference. Either you are calculating NPV in real terms or in nominal terms, because in both the ways, your present value will be same. Your NPV will be same. So when there is a single inflation rate, then there is no issue at all. Either you are working in real terms or in nominal terms. No issue at all. Okay. Now, you need to learn one more point. If you just go back to the Fisher effect, which we did discuss in the previous class, that is 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. And we did discuss this inflation, which we use in Fisher effect, that is journal inflation. You can also write like this, like 1 plus real rate is equal to 1 plus nominal rate divided by 1 plus inflation rate. 1 plus nominal divided by 1 plus inflation. Okay. Now, please try to understand. What is happening? 1 plus nominal rate. We are dividing 1 plus nominal rate with 1 plus inflation rate. And this inflation rate is a journal inflation rate. Okay. We have seen that how to convert real cash flows to nominal. We have seen that. Done this. Now, I'm assuming, just for the sake of explanation, assuming, just an assumption, okay, please. Let's say first year, second year. Let's say in the first year you have included the inflation and the sale amount. I'm just assuming it's 1,50,000. In the second year, sales amount is 1,75,000. And we have, let's say, included the inflation rate in this sales. Assuming inflation rate relating to the sale was 10%, let's say the variable cost is 50,000, variable cost is assuming is 57,000, and let's say we have included inflation rate in the variable cost also. Assuming in sales the inflation rate was 10%, variable cost assuming inflation was 5%. So I'm just assuming this sale value is with inflation of 10%, variable cost also includes the inflation, and let's say variable cost includes the inflation of 5%. Okay. Let's take fixed cost, assuming 20,000, and let's say 20 and 20,800. So this fixed cost includes the inflation of 4%. Just I want to explain something. Okay. Let's say 1,50,000 you have taken. Then what do? We calculate net cash flows, then we calculate tax payments, then we add tax saving on capital allowances. Everything is fine. But now please try to understand. Let's say I have calculated taxable profit. Here it is 80,000. So 1,75,000 minus 57,000 minus 20,800. That is 97,200. And let me repeat again. Sale was having the inflation rate of 10%. Variable cost was having 5%. Fixed cost inflation is 4%. You have calculated, let's say, taxable profit in nominal terms. Then you will calculate the tax payment. Then tax saving from capital losses will be added. We will get net cash flows and so on. Let's assume you have already calculated the NPV in nominal terms. And project is having a life of 2 years. I just want to tell you one thing. Now, in the same question, there's another requirement for 2 or 3 marks. An examiner is saying in the next requirement, calculate NPV in real terms as well. First, it was categorically clearly mentioned to calculate in nominal terms NPV, and let's say you have calculated NPV in nominal terms. Now, examiner is giving you just 2 marks. An examiner is asking you to calculate NPV in real terms. Now, actually, what examiner wants you to do, now you have to convert nominal cash flows to real cash flows. We have seen how to convert real cash flows to nominal. Now the time has come that you will be converting nominal to real. So how do we convert nominal to real? Simply these taxable profits, they are nominal cash flows. I will divide this with 1 plus inflation rate. Which inflation? Journal inflation. I'm assuming journal inflation is 6%. So 1.06. Here it will be 1.06 power 2 for the second year. If there's a third year, so I'll take 1.06 power 3. So what you are going to do? You will divide these, let's say, taxable profit with the inflation rate. You will get the nominal cash flows will be converted to real cash flows. So you can say formula, equation, whatever. It's very simple. How do we calculate real cash flows? Is equal to nominal cash flows divided by 1 plus inflation rate. Which inflation? General inflation. And power n. Obviously, for the first year, power is going to be 1. For the second year, power is going to be 2. For the third year, power is going to be 3. So this is a simple formula to convert nominal cash flows to real. So real cash flow is equal to nominal cash flow divided by 1 plus inflation rate, and the power is n. So there's a possibility that an examiner can ask, and examiner has obviously asked once also. An examiner can ask in multiple times as well. That first examiner has asked you to calculate NPV in nominal terms, then examiner gave just a small question of 2 marks to the student to calculate NPV in real terms. So you'll be using this formula. And next point, we know that when, okay, yes. Look at this. Sale is having inflation rate 10%. Variable cost is having inflation rate 5%. Fixed cost is having inflation rate 4%. These are the taxable profits. What I did, I have just divided them with journal inflation. 1.06, then power 2. For the third year, there will be power 3. Is this clear now? That is why I clearly mentioned 10%, 5%, 4%. So first you have simply calculated the NPV in nominal terms. But if in the same question you are required to calculate NPV in real terms, so this is how you calculate. So you're working on taxable profit. Now let me tell you one more approach. That is also 100% acceptable. There's no issue at all. Examiner is going to accept that as well. Or let's say T0, T1, T2, T3. You have calculated let's say you have calculated net cash flows in nominal terms. Assuming T0, the investment is $10,000. T1, you have taken sales, variable cost, fixed cost, tax payment, tax saving from capital allowances. You have considered each and everything. Let's say it is 15,000. It is 18. It is 22. Now listen carefully. This is another presentation and equally acceptable, equally. Rather than working on taxable profit, you can do one more thing. Net cash flows before discounting, you have calculated in nominal terms. Now, what we are going to do, if examiner has given us 2 marks to calculate NPV in real terms, look at this. 15,000 divided by 1 plus, I'm assuming journal inflation is 6%. Obviously, whatever values comes, if you want this, power will be 0. Any variable which is having power 0, it is equal to 1. I'll get 10,000 negative. Now, whatever results are coming here, whatever, simply you will take a real cost of capital because you have converted nominal cash flows to the real. So just take real cost of capital and calculate NPV. So if you have time, then take the taxable profit, divide this with the inflation rate, then you will get a taxable profit in real terms, then calculate tax payment on that, then add tax saving from capital allowances. Otherwise, if someone is solving the same question like this, before discounting, just you have taken the net cash flows and you have converted those net cash flows from nominal to real. Both approaches are 100% acceptable, 100%. So please, there's no need to get confused. For example, you might see that BPB is solving the same question in a different way. Let's say Kaplan is solving the same question in a different way. So what I did, I have discussed both the approaches in front of you. The main concept is both approaches, both presentations are 100% acceptable. So at least you have to know both of them, but at least you should be able to apply any one of them in which you feel convenient. So if you ask me, I'll say the second one is more easier. What we are doing, just we are taking the same net cash flows which we have already taken while calculating NPV in nominal terms. Just take those cash flows and convert that into real terms. But obviously it's up to you. I have explained you both the presentations. Now, another concept is regarding working capital. Basically, when we invest in a project, so we do not only invest in non-current assets. We do invest in working capital as well. Repeat. Obviously, when we are investing, so we are not investing only in non-current assets. Obviously, we are investing in working capital as well. Because if you're not investing in working capital operations, you won't be able to start the operations. Okay. A very simple meaning of working capital is current asset minus current liabilities. There is one assumption, and we solve all the question of FM and even AFM according to that assumption. We assume that working capital can never be consumed. There is an assumption, working capital can never be so simply whatever you have invested in the working capital, entire amount will be recovered. Repeat, working capital can never be consumed means whatever we have invested in the working capital at the end of the project life, entire amount will be recovered. Another concept is the nature of the working capital is current asset, and obviously we never pay tax on current assets. So it is highly advisable if in the question you have working capital, you have given working capital as well. Always deal with the working capital after you have calculated the tax payments. Because if you're going to deal with working capital before the tax payment, so obviously your tax payment will be incorrect. Why? Because working capital nature is current asset and nobody pays tax on current asset. Taxes we pay on taxable profit. So let me repeat, working capital can never be consumed means whatever we have invested in the working capital at the end of the project life, it will be recovered. For example, let's say T1, T2, T3, T4. Examiner is saying working capital required. Okay. Let's say examiner is saying at the start of T1, we need working capital of 20,000. If it says start of T1, you have to show that at time 0. Now examiner is saying assuming at the start of T2, at the start of second year, we need working capital requirement is 30,000. At the start of T2, working capital requirement is 30,000. Okay, now keep listening. Here actually we need 30. Let's say examiner says at the start of T4, we need working capital of 45. Okay. When examiner says at the start of T2, we'll show that at the end of T1. When examiner says at the start of, let's say, T3, then we'll take at the end of T2. Now, obviously, when we are going to solve the question, we will always work on incremental working capital. So working capital and recovery. At time 0, it will be 20,000. Now, actually, from 20, we are moving to 30. We have already invested 20,000 in the working capital, so additional investment will be 10,000. Now, from 30, we are moving towards 15, 45. So additional is 15. So working capital can never be consumed. Whatever company has totally invested in the working capital, everything will be recovered. So logically, the total investment is 45,000. So entire amount will be recovered. And technically, logically, mathematically, the answer must be zero. If you take this 20,000 negative, 10,000 negative, 15,000 negative, and then 45,000 positive. So whatever you have invested in the working capital, it can never be consumed. Okay. This is how we deal with the working capital. So student, we have discussed how to convert real cash flows to nominal. We did discuss the concept of the relevant cash flows. We did discuss how to convert nominal cash flow to the real cash flows. Plus, we did discuss this. If current prices are given, what to do. Year one prices are given, what to do. And we have also discussed the concept of working capital. The assumption in working capital is working capital can never be consumed, means whatever you have invested in the working capital, entire amount will be recovered. Now, there are two possibilities relating to the working capital. One, the working capital requirement will change every year. Like in this example, it is happening. Initially, it was 20,000, then total 30, then total 45. So actually, working capital requirement is changing. There's one more possibility that working capital requirement remains same. Let's say at time zero, we just need to invest at 10,000, no more investment. If this is the case, then 10,000 will be recovered here. Why? Because working capital can never be consumed. But the second example of working capital is representing when working capital requirement is constant throughout the project life. Then the second presentation, once at time zero, you will show the outflow of the working capital, and at the end of the project, same amount becomes an inflow. But when working capital requirement changes every year, then this is the example. How do we deal with that? So obviously, if working capital comes in the exam, either the requirement is going to be changing every year, or it's going to be constant. There's no third possibility regarding working capital. Plus, I have already explained, you should deal with the working capital after you have calculated the tax payment. Now, students, we have almost discussed more or less all the rules and concepts relating to NPV in the previous class and today's class. Now, student, from the next class onwards, we will start doing the questions. So from the next class onwards, we'll start doing the questions. Again, deliberately I'm keeping this second class short, but definitely now after this class, we will be doing questions of investment appraisal, and majority of the question will be from the latest attempt. Plus, I will make sure that we should be doing questions which you have not seen before. So students, that is all from my side. So thank you very much for taking out time to attend the class. Do give the feedback of today's class. That encourages your tutor as well as other students so that they should join also from the next class onwards. So students, thank you very much. See you all, inshallah.